Let's welcome in Ajay Tyagi, Head of Equity at UTI Asset Management Company, who's with us with some perspective on things. Ajay, good to have you back. It's been a while. Thanks for your time. And tell us, Ajay, what have you been doing? Did you typically, I don't think you guys take cash calls one way or the other, right? So remain fully invested, but what kind of activity have you seen? I mean, you know, your fund managers, your team, etc. at UTI AMC, with regards to sort of deploying more money which is coming in, or just give us a sense.
Sure. Yeah, Prashant, good to be back. See, I mean, our view over the last 12 months or thereabout has been, cautious about the markets, and more particularly cautious about mid and small caps. You know, you can say that we are slightly early in terms of sounding cautious, but over the last few months, the markets drift downwards. We think this drift will continue for some more time, possibly a few more quarters, and looks like 2025 would be the year of consolidation for the markets. The primary reason for our call is basically the valuations. If you put the valuations in context of what they have been over the long range, even now, after this 10% fall from the top, or maybe 15% fall from the top, you still see these valuations to be scary. So, our view remains, that of caution. As far as our activity is concerned, in line with our overall thinking, we have been, circumspect about, some of these mid and small caps and some of these hot sectors which actually blew the lights off in 2024. And we would say without any real fundamental improvement in quality of earnings. I think that is already starting to reverse, but we may see, more of that coming quarters. Yeah.
Okay, Ajay, got that. Good to have you on the show this afternoon. It's been a tough patch for the market now, running into several months. So, any key changes to the portfolio that you've been making in terms of perhaps, easing out positions, taking some profit, and now that we're down so much, maybe fresh purchases in areas where earlier you found valuations to be too high?
See, as you're aware, I can't be very specific about our actions, but what I would certainly say at this stage is that things have gotten slightly better from where they were, but not to a level where we are comfortable. I think, the market got overdone on the way up. Now, every 5 or 10% correction obviously looks to be an attractive position relative to where we were in August and September. But if you look at valuations from a slightly broader term perspective, we still haven't got into comfortable zones. I would say the pockets of comfort remain the same. Private sector banks is something we've been comfortable of. That's one area which still looks very comforting. The earnings quality for some of these banks is actually improving. So that's one area of comfort. I would say auto OEMs is another part of the market where valuations didn't go overboard. And I think that's, again, one area where we are finding opportunities which are favorable in terms of risk return. For most other parts of the market, things have improved, but not come to a level where we want to use our dry powder yet. Yeah.
All right. Hi, good afternoon and good to see you, and sir. Wanted to ask you about some of these fancied sectors, the delivery companies like Swiggy, Zomato. People wanted them at higher prices. We were getting lazy, a lot of usage out there. But these stocks have come off dramatically from the top. You're interested?
Again, I'm afraid can't be very stock specific, but let me give you the broad thought process.
On the theme, sir. On the theme. Do you think that, yeah.
See, let me just take a step back. Anything which is high beta in nature, regardless of the underlying earnings and the underlying strength of earnings into, both the near future and the medium term, would obviously fall more whenever there's a slightest of correction in the market. I mean, if you go back and look at, for instance, since you're speaking about new age companies or tech platforms in India, if you go back and look at the behavior of some of the tech platforms in the US between 2000 to 2024, regardless of what they delivered over a 2-decade period, they were the ones which were pummeled the most whenever markets saw the slightest of correction. That's just the nature of this beast. high beta names, high P stocks at the slightest of correction in the market fall disproportionately. So one must acknowledge the fact that this is how the price of such kind of stocks would always behave. Now comes the other thing. How are the fundamentals tracking? I would say yes. The anxiety in these names and this sector per se is on account of competition heating up. Some of the competitors actually giving discounts, because of which the incumbent players are seeing their margins getting pushed out into the future. To our mind, that seems to be a phase which will go on for a few quarters. It can't go on endlessly. Remember, the challenger is also wanting to IPO at some stage, and obviously this IPO can't happen, if losses continue to widen. So there will be some sanity returning back in terms of margins. The opportunity seems to be very, very large, and nowhere in the world has a proof of concept been established for quick commerce companies, but here in India, proof of concept has already been established. So, despite this breakneck speed of growth, the leader barely burns any cash. So yeah, I mean that's my comment on the fundamentals, and I already spoke about the fall in prices. Yeah.
So broadly, the view is you are saying maybe slightly sideways for at least a few more months, right? As far as the market is concerned, nothing exciting, not the fast and furious game once again, at least not for a while, that we all have become very used to. But as we come back, do you think it happens quite often that for example, EMS etc. have been leaders of the last, I mean this big phase, absolutely at the frontier. Will those be once again at the frontier whenever the market starts to look better? Or you think, I mean, there'll be a factor change? What's your sense?
Prashant, that's an excellent question. I would say there is always a bit of rotation whenever the markets rise back, from a correction and after having a bloody nose, so to speak. But there are some themes which go beyond just an interim correction. If the Indian government is really serious about making India a manufacturing hub, if they come back with a PLI scheme on components, which is what we keep hearing about, if they are serious about giving subsidies for making fabrication units here in India, I would say that some of these EMS companies would have a very, very long growth runway. Do remember, the Indian government has also been talking about export opportunities beyond just the domestic demand. So I would say a lot depends on the government policies. As of now, we do hear that while the PLI assembly is going to end in 2026, but before that, we're going to see a PLI for components so that we can capture a larger share of bill of materials. And if that be the case, that's going to be good news and would add a further growth driver for EMS companies. Yeah.
Okay, so that could be a space to look at as well. Ajay, it's been a pleasure having you on the show today. Thank you so much for joining in and sharing some of those insights with us. That's a view coming in from UTI AMC. Back to the market, it's very, very quiet out there, not much moving, 20 points lower. On the Nifty, the mid-cap index is also completely flattened out. On the Nifty, BEL is actually doing rather well in this otherwise dull afternoon, 4% higher. BEL is the top winner on the index at this point in time. Let's move on. We